Good morning from the Asia Pacific. It's 9 a.m. in Beijing and Hong Kong. We're just moving to 10 a.m. here in Seoul. Welcome to Bloomberg Markets Asia. I'm David Ingles.
I'm Rishaad. Salamat. Let's have a look at our top three. We've got stocks and bonds slipping. The Fed chair pushing back on hopes for imminent policy easing. Jay Powell repeating that a March cut is unlikely, warning against the danger of moving too soon. China's pledging to stabilize its markets after shares to sink to a 5-year low, but officials offering no specifics on ending the sell-off. Plus, we're looking at Middle East tensions as they hit new highs after a wave of US-led strikes in Iraq, Syria and Yemen, with Washington really warning of more to come. All right, those comments, Dave, coming out of Jay Powell, certainly reverberating across markets.
Yeah, Rich, we're just going to go straight to breaking news right now. Out of the Korean FSS, and really talking about, I guess, in many ways goes into the conversations and this repricing that's taking place in global markets with the dollar stronger, probably March not on the cards according to Jay Powell. We're seeing weakness across the currency markets, across the Asia Pacific, including here in South Korea. We're getting some lines coming out of the regulator talking about how they're vowing to end illegal shorts. These probes going into the global banks here, they're looking at stern steps against mis-selling of some of these China-tied equity-linked securities. It's certainly a conversation that's really made the headlines I would even say the last few months here in South Korea. Certainly the exposure of retail investors to just the rout in equity markets in China. There's also really to the point of the macro story of higher rates as well, project financing and the risks associated in the exposure of the banks there. So we're getting a lot more lines coming through that they will not be tolerating the mismanagement of these risks, Rish. So I guess we'll get more on this story in a moment, but certainly it's a stronger dollar story that investors have to contend with at this point in time.
Well, that's absolutely right there, Dave. And we are looking here at, the prospects here for the futures telling us what going to have more pain put on markets. So once more, looking at those futures down about 0.5%, looking at S&P futures as well. After Friday's stellar gains, after that, unbelievable jobs report showing such strength of the U.S. economy. That's all been played out on the session there on Friday in the U.S. We've got futures adding a bit of pressure. Nikkei 225 off the highs of the morning so far, at least. And we got in prospect, of course, that interest rate hold by the Reserve Bank there in Australia, and is coming off record highs there, that market. And there we go. And where you are, Dave, we've got a Kospi, which is a 1.6% to the downside and opens elsewhere, indicating, movement again lower. Let's just have a look at also what we've got playing out at the moment. That pledge by the Chinese authorities to stabilize markets could give the indices a boost, but seemingly it's not likely to. But the problem is here that some are saying it's just basically too little, too late, even though we have a lack of specifics. Going to be looking at that fix as well. There we go, the yuan, 7.21. Quick, just check with what's going on as far as the Treasury and other markets go. Bonds at the moment, there we go, 10-year with the 4 handle again. Saw those Treasury futures dipping and reversing back at one stage and then going back down again as those headlines from Jerome Powell's TV interview and the headlines from that landed on screens across this part of the world. And, is it an algo-driven reaction? Well, we'll have to really see how it all plays out for the time being. But employment, as we know, is robust, as it has been indicated by that non-farm payrolls report. We've got BCE, the favorite measure of inflation there for the Fed. That's slowing down, and productivity remaining strong. It's essentially still that message to markets, still repeated from the December mantra, 75 basis points of cut. So there we go. Dave, let's have a bit more on what else is going on.
Yeah, and certainly the context going into this this new trading week in China, certainly we'll talk about this in a moment. Certainly these promises for more measures. You know, what happened on Friday was quite wacky, right? You had a massive drawdown in the CSI 300, down over 3% at one point. It recovered, but, on a whole, we saw the worst week in onshore China going back to October of 2022. That was when we were in COVID zero on the Chinese mainland. Interesting today is you're getting this 10-year CGBS you were just showing there, Rish. now with a 2.3% handle that takes us all the way back 24 years. And the fix coming out in a few minutes should be interesting to see, and whether or not, with the dollar strength coming through the falling yields that we're seeing in China, whether or not the PBOC steps in more firmly today to anchor the currency. It's busy and it's quite early, but we'll see what happens here, Rish.
All right, well, indeed. Let's get over to Chief North Asia Correspondent Steve Engel, who's with us now. In Chinese stocks, well, how are they looking overall? Because, I mean, we've had promises before, promises here. The regulators want to stabilize the market. Again, we don't have quite the specifics here. What's the deal?
Yeah, I think investors are looking for specifics on what kind of steps they're going to be taking place. The CSRC, the securities regulator, Sunday essentially put out a statement saying that they will pledging to stabilize the market. But in what form, really? I mean, I think there's been a lot of scuttlebutt over the last month or so about a stock stabilization fund, but talk about how large that will be and where it will come from and the like. We had the Chinese Academy of Social Sciences also kind of call for a very large stimulus of a stock stabilization fund to the tune of $1.4 trillion. I can talk about that in a little bit. But again, the signals coming from Beijing is they're obviously worried about the stock rout on Friday, down 3.4% for the CSI 300. The frustration is palpable in China with investors, a lot of mom and pop investors in the mainland just ahead of the Lunar New Year holiday. So it's not good sentiment going into there. The statement from the CSRC is saying basically they're vowing to prevent abnormal fluctuations in the market, like what we saw, the chaotic trading on Friday, saying it would give more medium and long-term funds into the market. Again, we don't know the size or how that would be taken place. Crack down as well on illegal activities, including what they call malicious short selling and insider trading. But again, the backdrop of all of this is a weak Chinese economy, not enough, according to a number of investors, concrete measures to put a floor on the troubles in the property market. And then at the backdrop is the simmering U.S.-China difficulties, geopolitical stress that does not bode well necessarily for exporters and the Chinese economy.
Yeah, Steve, in fact, the latest iteration of that is, and arguably a new factor to consider here, are these comments coming out of Donald Trump. And what more can authorities do, apart from jawboning, and obviously the problems of the economy will take time to sort, in the short term, to buy themselves time and stabilize this market amidst all of that?
Yeah, well, Trump's doing a lot of jawboning, talking about upwards of 60% tariffs on Chinese goods if he's elected in November. That is souring the mood. The investors already hit with all these losses in Shanghai and Shenzhen. And again, we talked about that stock stabilization fund that is in theory right now. Whether it will come out and how large that would be, sources saying it could tap into the offshore accounts, essentially, of state-owned enterprises to inject funds. And again, I mentioned the Chinese Academy of Social Sciences. One of the top academics there telling 21st Century Business Herald essentially that the national team in China, again, the SOEs and the like, are what's propping up and stabilizing the market right now, and as little confidence on the individual investors, and of course institutional investors are cautious right now. But again, the return of Trump is a top concern, according to Goldman Sachs, on a survey of its clients and investors in the mainland, that the return of Trump is a top concern, and the stresses that he might bring to the market.
I mean, he's the alpha, isn't he? He's getting more and more so as the election comes nearer.
Well,
and nearer.
as it comes closer, it becomes a greater reality, or potential reality.
Yeah. Okay, we're going into the Chinese New Year as well. It is going to be something to behold, the amount of travel, as usual. It's going to be key for the economy, I suppose, in many ways.
Well, sure. I mean, see if the consumer comes back in full force. Obviously, the Ministry of Commerce, MOFCOM, has talked about 2024 as being the year to promote consumption. And during these big week-long holidays, consumption usually picks up. It's probably not going to pick up in property. But again, as they travel around the nation, will they be spending enough to boost confidence?
Good stuff. Thanks, Steve. Steve Engel there, of course, our Chief North Asia Correspondent. Of course, all of this with the mood music also being set by the Fed Reserve Chair, Jerome Powell, saying the policymakers will likely wait beyond March, reiterating that before they move on interest rates. Speaking with CBS's 60 Minutes, saying that the central bank needs more assurance that inflation is on a sustainable path to that 2% goal.
And I wonder, to what degree does politics determine your timing?
We do not consider politics in our decisions. We never do, and we never will. It's not easy to get the economics of this right in the first place. These are complicated, risk balancing decisions. If we tried to incorporate a whole nother set of factors in politics into those decisions, it could only lead to worse economic outcomes. So we simply don't do that, and we're not going to do it. We haven't done it in the past, and we're not going to do it now.
There are people watching this interview who are skeptical about that.
I would just say this. Integrity is priceless. And at the end, that's all you have. And we plan on keeping ours.
Wow, that's Jay Powell there. Let's get to Joanne Chua. She's Chief Asia Pacific Economist at Citigroup Global Markets. This is a reiteration of what he said before, right, Joanne? What's your takeaway?
Look, our takeaway is the data in the economy in the U.S. has actually been still fairly resilient. We had a very
Look at that jobs report. Exactly. It's unbelievable.
So we had a very good non-farm payroll number. So I really think March is too soon. Obviously the market gets too excited. Clearly we've had a very nice kind of decline in disinflation from core PCE. But our house view is the Fed's probably not going to ease until June. I think the fact that you still have average hourly earnings running at a 0.6% month-on-month, annualized growth rate in earnings is still too high relative to the 2% target, means that they should be careful and wait a little bit longer. And so that's why we have it at June. And then maybe when they start going in June, they will start cutting steadily. So this year, we still have 125 basis points cut for the year.
Okay, very quickly, Jay, what does this then play? How does this play out for Asian central banks? That's what your remit is essentially, isn't it?
Sure. Look, I think most of Asian central banks, again, a lot of central banks in Asia didn't hike a lot, so I guess we're not really going to cut a lot. And most central banks, especially some central banks that are still quite sensitive to the balance of payment, will probably wait until the Fed cuts before they ease. Now, having said that, there are exceptions. In China, we've had 9 consecutive months of 0 to slightly negative deflation print. We're probably going to have another deflationary print this week. So obviously China, we're still calling for a cut. In fact, they should cut earlier, and they've disappointed. So that's a central bank that can cut ahead of the Fed. But the fact that the Fed may have to wait longer, and to the extent that PBOC cares about renminbi stability, it is complicating the timing of the policy space for easing. The other central bank that we think can deviate a little bit and cut ahead of the Fed is Thailand. So we just changed our call. We've got a central bank meeting in Bank of Thailand this Wednesday. We don't think they're quite there yet in cutting this Wednesday, but we do think, given the data disappointments that have been coming out of Thailand since November until January data, and the fact that the fiscal policy seems to be getting delayed, we think Bank of Thailand is another central bank that can cut a bit ahead of the Fed.
Yeah, Johanna, you highlight two important, at least landmarks this week for Asia. You have China inflation and, of course, that rate decision out of Bangkok. Just more on the inflation story, if you could. I know we've talked about this, whether China now was Japan a few decades ago. When do you think price pressures will emerge in mainland China? And I guess connected to that, do you think the yuan remains a funding currency?
Right. So the challenge right now is, for example, this print, we still have negative 0.5 for CPI. PPI still negative 2.8. The challenge is, even though we are expecting inflation to pick up on the back of, mainly because of pork prices correcting, and the reality is pork prices are still flat month on month. Normally, seasonally, ahead of Chinese New Year, there should be a lot of demand for pork, but actually prices are still quite soft. I think the challenge is, even though we get some kind of volatile components that could hopefully drive CPI to positive territory, what is important is the underlying inflation momentum, and core inflation is still very subdued. And my worry is, as long as the real estate continues to struggle, as long as we have a lot of heightened uncertainty, including now heightened uncertainty on the back of Trump policy, for example, that will obviously create a drag to private sector aggregate demand, I think the pressure on deflationary pressures is going to persist. And I think the fact that central bank PBOC has kind of too many policy objectives. PBOC is also looking at preserving net interest margin of the banks to safeguard financial stability, so the banks can replenish capital using net interest margins, and the fact that deposit rate cuts are not transmitting as effectively, and the fact that they also care about renminbi stability. So these multiple policy objectives is kind of contradicting the kind of policy stance to support reflation. And so I actually think nominal policy rates are just too high, and real rates, expected real rates, are too high. So I think raises the risk of a more persistent underlying deflationary pressures. Never mind the fact that you might have volatile components of CPI driving headline to positive territory eventually this year.
And might a global easing cycle help? If when that comes this year, that's number one. And last year, arguably, China was still dealing with the after effects of COVID on its finances. So if we do get a global easing cycle, one, an easy monetary policy cycle in China, number two, and fiscal policy in China to support that, what's the best case scenario when you have all those three arrows?
So certainly a global easing cycle, if that's really being driven by a calibration of policy, because we're getting this nice disinflation path, so they're cutting rates to kind of accommodate the disinflation, that would help at least provide a better outlook or better prospect for a soft landing. That would be good. Of course, if we're going to a global easing cycle because of hard landing concerns and a recession fear, that would be bad. So I think that's something that we need to watch out for. And then, of course, in China, I think a lot of the heavy lifting of policy is going to be relying a lot more on fiscal policy rather than monetary policy, because as I said, there's a lot of these conflicting objectives in terms of financial stability, preserving net interest margins, FX. So they're going to have to lean on fiscal, quasi-fiscal. So that's all eyes are going to be on the NPC meeting on March 5th. And we are expecting the central government budget deficit to be expanded by another extra trillion, so 3% to 3.8%. We're expecting carryover funding from last year from the amended budget being transferred over to 2024. That should add a little bit of a augmented fiscal stimulus of about 1.3 percentage points. We're hoping, the PSL, which could carry it over this year, will provide a bit of support. Now, the challenge is that will help at the margin, but, we're still kind of concerned about real estate. Our house view is physical real estate market in 2024 is going to be no better than it is in 2023. And you have to add that drag on real estate with all the other fiscal, quasi-fiscal, and push on advanced manufacturing, to what extent that can offset each other. Right now, obviously, for 2024, we have a forecast of 4.6% growth, which will probably be below what the growth target they're going to set at 5%. And I'm not sure this growth is really going to be significant enough to kind of, address some of the deflationary risks that we're still facing. And in reality, for equity markets, it's nominal growth that matters, less than real GDP growth, which is what policymakers are targeting.
Which is at the fix is quite something. It's the strongest one that we've had against estimates since, November or thereabouts, at 7.10 as opposed to 7.2, 1,000 pips here. Now, tell me something. What is the policy regarding the currency, and how does it play into the overall structure, the contours of what they're trying to do?
Look, I think right now, especially given there's risk of heightened policy uncertainty with trade tensions, potentially re-emerging in U.S. with Trump, potentially re-emerging in Europe, because obviously Europe's very concerned about autos. I do think PBOC is going to want to manage renminbi within a range, dollar CNY range, maybe between 705 to 730, that range. I don't think PBOC really needs to push renminbi weaker in order to reflate the economy. I don't really see that as the policy, because the reality is, in real effective exchange rate, because China's inflation, or should I say deflation, is actually lower than every one of its trading partners. So it's still very competitive. So I think they're going to want to manage renminbi within a range to kind of create less risk of heat in terms of political heat in terms of protectionism. But having said that, if the dollar does weaken, there is an opportunity to drive the CFETs lower, basically renminbi to weaken relative to the basket. But as you earlier pointed out, obviously the dollar, given the resilient data, that's been taking a little bit longer to adjust.
Jana?
All right.
Yeah,
Yes.
Jana, quick one here.
Dave.
Since I'm in Korea, I need to ask you about the chip cycle. We've started to see that bottom here, and I'm wondering whether the bottom that we're seeing across the trade story here, would that be reflective of something region-wide, or is that something that's more specific to Korea and maybe even Taiwan only?
So here's the thing. Historically, we always think semiconductors is like a leading barometer for the overall electronic cycle, which, as you know, is a very important source of export for the region. But the interesting thing is when you look at electronic export and the data, it's really just Korea and Taiwan that's really doing relatively well than everyone else. So there's this bifurcation of the electronic cycle. Like if you look at Southeast Asia, some of the data coming out of Malaysia and Thailand has actually been disappointing relative to the higher end, the chip cycle, which is benefiting Korea and Taiwan. And I think part of that bifurcation is the fact that China still has excess supply relative to demand, and China produces a lot of electronic products. And I think that is kind of convoluting the broadness of the manufacturing base, because price pressures are moving in the opposite side for some of the broader metrics. And that, I think, faces a risk on the strength of the manufacturing.
Jana, we could talk all day. Thank you so much.
Thank you.
John Chua there, Chief Asia Pacific Economist, Citigroup Global Markets. And, of course, we're counting down to the start of the trading day in Shanghai, Shenzhen, and right here in Hong Kong. We are back now. We're looking at the Biden administration saying it'll carry out more attacks on Iran's forces as well as its proxies in the Middle East, coming 3 days after airstrikes in Yemen, Syria, and Iraq. Bruce Einhorn is with us, getting us up to speed with all this, and quite a lot of, raising of tensions over the weekend, to say the least.
Yes, Rish, you're right. There's a lot of military activity. There's also a lot of diplomatic activity going on right now. So on the military side, as you mentioned, more U.S. and U.K. attacks on Houthi rebels in Yemen. This follows the first attacks by the U.S. and the U.K. forces, which began in January, early January. So the latest ones, according to the Pentagon, attacked 36 different sites in Yemen. They were going after missile systems, weapons storage facilities, launchers, air defense systems, radars. The Iranian Foreign Ministry issued a statement criticizing this, saying that it's further escalation, and saying that the U.S. and the U.K. are, in the words of Iran, fueling chaos, disorder, insecurity, and instability in the region. And the Houthis said that this is open war. The U.K. Defense Secretary did issue a statement saying that this is not an escalation, that this is just part of the additional attacks on this. And then finally, we got to talk about Anthony Blinken's on his way to the region. Now there are going to be talks about possible ceasefire, humanitarian assistance for Gaza.
Oof, that was a lot to go through. Thank you, Bruce. Bruce Einhorn there. You can see what's happening with the price of oil there. They've got a lot more coming up, including the start of the trading week across Greater China. This has been
Good morning and welcome back to shows. Minutes away from the opening bell, and we're looking at declines across these markets in Hong Kong with 1.3%, give or take, here on the regional benchmark. We're also seeing yields continuing to push lower, and we're down about 3 basis points on your 10-year. That now takes us back several decades. In fact, that's something to watch very closely. On the CSI 300, our starting point for the week is now within 10% of a new 9-year low when you look at that level, and you look at two key levels to watch moving forward. The 2019 trough is the red line on your screens, and the yellow line is actually the other one, which I think is a 2017 or even 2016 low. Below that, we're back to levels in 2014 on this index, so that's about 10%. That's about a bad 1 or 2 weeks away from that. So we're looking at that, and perhaps going into that story, potential measures to further stabilize this market. Certainly when you look at this bond rally, which has been ongoing for 8 or 9 or even 10 weeks, depending on which metric you're looking at, certainly expectations are for lower rates ahead. Some data coming through in about 20 minutes from now, and of course stocks to watch, Rish. We're looking at these big tech plays as well as Wuxi.
Yeah, we certainly are. Yeah, and looking at Wuxi, there we go, pre-market down by, half of 1%. We're looking at Alibaba coming out with earnings later this week, in fact, Wednesday there, and perhaps looking for anything in terms of a sale of Frishipo, our team mart. This is a Reuters story originally, and there you go, looking at that as we count you down to those earnings and looking at, we've got, of course, geopolitical tensions playing out with Wuxi. There you go.
All right, a good Monday morning from the Asia Pacific. Welcome to the program. Hope you're all well and rested as we head into a new trading week ahead on China. Two things here. We're waiting for more policy supports to stabilize these markets, and certainly with the pricing you're seeing on your screens, this market does need a further action to provide a floor. We're seeing yields pushing lower, a weakening currency that's really on the back, Rish, of these comments coming out of Jay Powell. And certainly when you look at pricing for a March cut out of the Fed, that's certainly almost been priced out completely. And you look at May, that's certainly no longer a base case.
Yep, and we are, of course, looking forward to the open now for the week, and we are just seconds away. Of course, pre-market seeing also futures move to the downside here. We had that yuan fix as well, quite something here. That reference rate, 1,000 pips actually above, or should I say, below the estimate, if you will, here. The strongest fix that we've had since November. There you go. This is a sector breakdown already. Got tech in the mix here on the way down. We're looking perhaps at Alibaba, responsible for the decline there, largely speaking. looking as where we go. Financials also weaker. We've got that sell-off continuing as far as these Chinese equities do go. Let's have a look at some of the individual kind of sectors, if you will. Tech stocks, that story at the moment really being dominated by Alibaba. Was down pre-market over 2%. We've recovered somewhat. We've got Tencent just coming back after some of the gains that it did see after the approval of one of its key games here, along with, of course, Nexon and various others, which we did see, of course, see that big move to the upside last week before they did pair some of the gains. We've got Wuxi Biologics at the moment protesting that they do not pose a national security risk to the US. Here we go. And, well, this is a surprise here, really, in some senses, given that these EV makers are just a moment looking at this purchase tax at the moment. The Ministry of Industry and Information issuing a list of new vehicle models that will be exempt from the vehicle purchase tax. And that, of course, should perhaps be giving them lift. But at the moment, we don't see that. It seems like this sinking tide is sinking all boats right now, Dave.
Yeah, and certainly that against also, I wouldn't say toxic, but certainly a counterproductive macro environment that's keeping Chinese assets really from finding a floor. And the stronger dollar is certainly something that we need to talk more about going into this week, where the dollar's up against everything as well. I'm here in South Korea. The exchange rate yesterday is certainly much different from where it was this morning as I came out of the airport. Let's start on the macro themes and move to China. Yan Wang joins us right now, Chief EM and China Strategist at Alpine Macro. Yan Wang, good morning from the Asia Pacific. I was hoping to start off with just the outlook here on macro and the Fed. It's certainly a reminder that this easing cycle is not going to start as soon as markets wanted it to start. What are your thoughts on the hopes right now getting priced into this market?
Well, I think as far as China is concerned, I don't think the Fed really matters that much. I think the problem in China today is the economy is weak. So if they can actually push strong stimulus measures to make the economy stronger, I think the RMB will not be under the downward pressure. So I think the problem is pretty much kind of China related, not really about the Fed.
Okay, understood. So we'll talk more about the China story then. We were bantering just during the ad break going into this their chat today that for the better part of last year, policymakers were trying and putting in place policy measures to address the economy. And arguably, we're 12 months into that story. Should we be concerned over not so much the intention, but the toolbox that they have to deal with the current issue?
Right. Yeah. So I think if the economy just continues to remain at this below par deflationary environment, then I think the policymakers will pretty much kind of exhaust their policy tools, because for now, you have deflation, then interest rate cuts itself probably doesn't really matter that much. So so I think they do need to take aggressive and preemptive measures to really backstop the growth problem for now. So so I think they have been saying that they are trying to conserve, to be conservative, to keep some policy tools in the toolbox. But the problem is, if the economy continues to deteriorate, I don't think, that option will be there for much longer.
And the pressure's on, isn't it? I mean, if they continue to let the economy, perform suboptimally, this can actually expose all sorts of other, perhaps, fissures and fractures within it.
Right. Absolutely. Yeah. So that's why, they have been policymakers in the past couple of days, probably 2 weeks, they have been really trying to pump up the stock market. But so far, all these measures have failed. It's precisely because all these measures don't really address the key problems in the economy, which is very weak economy. And then you have structurally, you have this confidence crisis. So I think policymakers really have to address those two issues so that the market can find the bottom. But for now, policymakers are still kind of dragging their feet. So I don't think the stock market will find a kind of sustainable floor without further policy easing or aggressive measures to really revive business confidence.
Yeah. Yeah, and a lot of that is the wealth effect that we see that play out, and that's down to the property side of things. But what would you be doing here? Okay, you can perhaps put a floor under the property market, but you've got to revive the rest of the economic environment, i.e., engender those animal spirits, which whenever they reappear, they seem to be whacked down.
Right. So I think a couple of things that we will probably need to monitor. So far now, we are still cautious. We believe the market, obviously, you have extremely deeply depressed sentiments if the market is cheap. But on the other hand, there is no clear catalyst. So for some kind of catalysts, a couple of things that we can monitor. One is what kind of growth target the Chinese government actually tries to achieve for the year, right? So if they kind of publish a relatively ambitious growth target for the year, and then that means that they would have to use a lot more aggressive policy easing to achieve that kind of growth target. So I think that will be actually a positive sign. Another one is the housing market. In the past couple of weeks, I think what really changed is if something that really matters, I think, is the housing policy. Now Beijing allows local governments to use specific measures to stimulate the domestic property market. So I think that may actually change the housing market dynamic. So I think if the home sales begin to stabilize, begin to improve, I think that may add a bit more kind of impetus for the economy. And then the third one would be whether the party will have the third plenum, what key policy measures that they will announce in the plenum. 10 years ago, there was a lot of hope the party leadership will would continue to advance reform agenda, but that has been delayed, obviously. So we need to see whether they can continue that kind of reform agenda. I think those will be important to revive business confidence.
Yeah, I was just having a glance at the date today, Feb 5. We're exactly a month away almost to the start of the NPC, and certainly the policy addressed there and the work report and the economic objectives. The rout in the equity market seems to be cornering the large part of the attention of markets. I want to ask you what's happening with the bond markets, because that actually is one part of the market that started to respond to policy stimulus, right? CGBs have been down 8-9 weeks. High yield bonds have been the outperforming group in Hong Kong. Is that the way to continue if you want any exposure to China? Is it through fixed income?
Well, the fixed income, the bond yield is pretty low already, right? So if our bet is ultimately the government will have to stimulate more, then I don't really see bond yields have much more downside. So I think stock market will be more interesting to watch, but for now it's just too early to jump in.
Yeah, Wang, thank you so much for joining us. Have a great week. Chief EM and China strategist at Alpine Macro joining us out of Montreal. And indeed, we're going to keep the fixed income theme going in some senses and have a look at what's going on with China's sale of local credit risk. Hedging, a hedging tool, I should say. This has been soaring. Companies have continued to struggle. And as credit markets contend with the impact of the slumping real estate side of things, conditions are ripe for that trend to continue. Bond and loan reporter Loretta Chen is with us now. What's the credit risk hedging tool that they are using, and what does it tell us about private firms' ability to raise cash?
Yeah, we observe a huge pickup in popularity of these so-called credit risk mitigation warrants. So they're kind of work like the CDS, the credit default swaps in China. So investors have the option to buy them in order to mitigate their credit risk exposure. And we're seeing that private companies over the past 2 years have been largely using these credit tools in order to sell bonds. So on the other hand, private firms are selling less bonds in the public bond market so far, and even with those credit mitigation tools, we're still seeing a drop. So it's very obvious. That tells you that investor appetite is not in that sector right now, and it's really hard for these firms to get financing.
Yeah, so there's some news about some projects of major Chinese developers being listed for financing support. Would that ease the credit crunch that they're facing?
Yeah, so Country Garden is the first firm to announce that news because they have so many projects across the country. And we're seeing that seems to be a local government-led drive. So in certain provinces such as Hubei, Henan, Shandong, these provinces have told certain developers, including Country Garden, that they have projects that have been whitelisted to get prioritized financing. So it's good news for the companies, for sure, because they don't have to scramble funds from elsewhere to fill that gap. But it also makes sense because originally, these firms have to put down funds with the local government in order to build that project. So the money is indeed with the local government. So it does seem that it makes sense that they are the one to step in to help. And then on the company financing side, those money are not going to go to the company to pay their other liabilities. So limited help, I would say, for the companies themselves. But yeah, good news for the home buyers.
Yes. Well, if there are any. That's the thing. Thank you very much indeed, Loretta Chen, that Bloomberg Bond and Loan reporter. Right, got a lot more coming ahead, including, of course, a look ahead to earnings this week out of China and beyond. This is Bloomberg.
All right, we're barely a few hours into the trading week, and already rates and FX are hitting us in the face. As your top macro themes today, as you can see, yields are pushing higher. This repricing that's taking place across the Fed Fund Futures Board. March is almost completely off the table now. May is no longer base case, 80% probability. You're seeing this also play out across the FX market. The dollar's making a strong comeback early this Monday. You're getting a weaker Korean won, for example. I'm not saying that just because I'm here, but certainly that it's more pronounced than usual. The won is weakening the most in about 2 months against the U.S. dollar, with the exception, though, and as you can see perhaps a bit later on, the Chinese currency is actually catching a bit of an anchor, maybe on the back of that PBOC fix. Some data's coming out in a few minutes out of the Caixin PMI numbers. In the meantime, though, what is causing this? It's the Fed and the rethinking of where they go and when they can go. Jay Powell has signaled that a March cut is now unlikely. Speaking with CBS 60 Minutes, he says the central bank needs to see more and needs more assurance that inflation is on a sustainable downward path. Have a look.
I think it's not likely that this committee will reach that level of confidence in time for the March meeting, which is in 7 weeks.
Right, well, all of that, and we got this background of some of these tech giants in Asia out with earnings. They include Alibaba. It does also follow hot on the heels of choppy results coming out of U.S. tech companies. Alibaba's results, of course, as ever, closely watched. The company dealing with internal turmoil and a stock market rout. Let's get to our breaking news editor, Felix Tam, who's with us now. And Alibaba, of course, is going to be absolutely key.
Yeah, of course. And we may see the earnings growth from Alibaba to continue because of the strong revenue in Taobao and Tmall businesses. And it is offsetting some of the weaknesses in the international commerce side. So for the policy side, we did see China rolling out measures to support the household consumption, and it can benefit Alibaba. And for the company itself, as you have mentioned, it is reshuffling the top management and also its organization by selling some of the stake in the unit. So we can see that the focus of the business for the business will be back to e-commerce and then cloud side.
Okay, so Alibaba, that's one. SMIC, that's two. Tell us about that.
Yeah, we just mentioned a lot of optimism for Alibaba, but this is not the case for the semiconductor industry. So SMIC, we may see operating income to slump about 80% because of the sluggish demand in the smartphone and the PC markets. And US a few days ago added more firms to the list that they consider helping the Chinese military. So this is an election year. We may expect to see this kind of back and forth between China and US on the macro side. For SMIC, so we really have to focus on the capital expenditures and also the price strategy.
All right, well, what about the wider tech side of things? I mean, look at, I think, Nintendo, and looking at SoftBank as well.
Yeah, so I think overall the recovery in Asia is pretty uneven, but it's rebounding. As you can see for the SoftBank earning estimate, we are expecting to see a profit after losses for 4 quarters because of the investment value of the Vision Fund. And for Nintendo, it's benefiting from the weaker yen to support the sales despite intensifying competition from PS5. So we may need to wait a few earnings like Tencent later this month or next month to see wider scope of the Asia tech.
Felix, thank you so much. Felix Tam there, our breaking news editor, just going through the earnings, which are going to keep him very busy in the next few days.
Yeah,
maybe.
exactly.
Thanks a lot, Felix. All right. Well, while we were talking to Felix, we got those Taishin services figures, composite services figure coming through here. Just a shade below estimates, 52.5 as opposed to 52.6. The services PMI, 52.7, just down from the estimate of 52.9. In fact, that was the actual figure of 52.9. So there we go. That is that PMI number coming through, and just quickly just checking in a little more detail on all that. The estimate actually for the PMI itself was 53. We got that read of 52.7, down from 52.9, of course, the previous month, which was, of course, December. These are January numbers actually here. There we go. Right, that's look at what's going on. This is the dollar, and you can see here as it sees a little movement there against the yuan after that much stronger than anticipated fix. This is a sector breakdown for the tech anyway, 1.3% down, dragging things lower. Hang Seng 0.8% to the downside, and overall we are in the red. We got much more on the way. This is Bloomberg.
Yeah, Rish, what a weekend. And certainly when you look at the weather in Hong Kong, I guess in many ways is an interesting juxtaposition with what was supposed to be a weekend of, celebrating who I think is the best footballer on the planet, bar none, across all time, Lionel Messi. But we could see a Messi fallout, no pun intended, because he just didn't, he didn't play, of course, in that much hyped up match that took place over the weekend there. He basically sat on the bench for the entire match.
Yeah, I mean, this was the Inter Miami coach said that I think it's Gerardo Martino. He did acknowledge their disappointment because there's a huge disappointment also from the government. They said that he didn't want Messi or indeed the Uruguayan star Luis Suarez from playing because of the risk of further injuring them. Well, we had, of course, the event did receive something like $1.9 million in funding from the government. And the government saying, Hong Kong government saying it was extremely disappointed and might deduct that sponsorship because of Messi's failure to play here, of course. And we had, of course, the crowd was shouting by the end of it for a refund. You can see the thumbs down by some of those supporters who came in and holding up Messi shirts. You can see there, much to their chagrin, he did not come out. We had this really against this background of Hong Kong trying to re-establish and restore its reputation as a world-class centre. And right. That, of course, after the strict pandemic curves. And, of course, the crackdown on the protests as well. Yeah, Dave.
Yeah, I was about to say, too, I mean, when news broke that the club was coming to Hong Kong and Messi and company were about to play, I think a few days after that, back in December, the ticket prices came out, expensive, obviously, and people were wondering what was the risk of him not playing. And I remember back then, a reason why fingers are not pointing, present tense, to the organizer, Tatler, was because what are the chances of him not playing? And I think Tatler back then, in fact, as recently as Jan 11, posted on their social media that, rest assured, they said that he was going to play. So interesting that they came out on, after this and also saying that they did not expect that to happen. I guess if they were trying to preserve his health, that's, of course, on the team. That's a prerogative of the team. But certainly the optics, and I think they should have come out and said he was not healthy, just so to, I guess, manage expectations and keep the crowd from doing what it did at the end of the match, right? And just not kept the crowd waiting to the end of the match to figure out that he wasn't, in fact, going to play after all. Anyway.
Yeah, I mean, it's what, 4,880 Hong Kong dollars. That's 624 US dollars for a ticket. That you know, they sold out within an hour when they went on sale in December, as you alluded to. I mean, quite something here. No wonder the disappointment was heightened. All right, well, we can, of course, have a look at what's going on now as far as markets go. It's not a great day. We had a 20% drop back for Wuxi on Friday. This is down, of course, to these geopolitical concerns about curbs being put on the company here. And what they're saying, though, is that operations do remain normal. Aptec, though, down 5.3%. We've got, of course, as ever, developers in the mix, too. And let's have a look at what's going on with some of these property companies and just seeing how real estate is at the moment behaving itself. There we go, Country Garden on the way up. Against a backdrop of overall Chinese markets, well, really, I suppose you could use the word languishing. You know, we've got them on the way down again and adding to the rout that we witnessed last week. This comes against a backdrop of the latest pledge by policymakers to try and stabilize what is a market that's really not gone anywhere down. It had indeed, the CSI had actually the worst week since 2022 as well. And we've got the Hang Seng China Enterprise Index, in other words, the 8 shares there, both of those really trailing most major equity benchmarks right around the world. And that stability pledge not really at the moment playing out and resonating, as it were. So there we go. And overall markets here, what are you seeing, Dave? I'm going to actually not talk to have a look at what's going on. Look at the Philippines. We've got the PSEI there up 0.5%. Just a bit of green out there. Seeing some green also for the Nikkei 225, but it is about Chinese stocks, which are really, at the moment, continuing their descent. So what is likely to happen? We've got a lot to come, and we've got Bloomberg Markets Asia coming your way next.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question.
Best question I get all night.
Bloomberg. Top experts. Great questions. Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto. The people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology. Start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
So you've built a successful company, but you might not want to run it for the next 10, 15, 20 years, or do you? And if you didn't, would you want to go into government if the president